Welcome to TMS Insights. It's mid-June and Ben Clark and Jeremy Hook bringing you some updates of the market. It's been a very healthy market of late as it's pushing up. Many companies hitting multi-year or record highs, Ben. So, real confidence really at this time of the year when it's not often the case.
Yeah, it's been a strange old year, hasn't it? Because year to date, I think we've done about a 6.5% return plus in dividends. And it's been patchy. Yeah. The banks haven't helped at all, and they're such a big part of the index. But it still feels to me like the index keeps wanting to push through this 6,100 level. And, I think if we see a contribution from the banks, which I think could happen over the next 12 months because they look cheap and unloved, then we could see a retest of the old highs at 6,800 at some stage, maybe in the next 12 to 18 months.
Yeah, that's good. And obviously some IT style of growth, stock focus has been dominant in the market, and value's been left aside a little bit. But to give all our viewers and clients a bit of a feel of what we've been up to of late, we've been attending a couple of conferences and listening to companies to get really stock specific. That's in the end what we invest in is companies. So to get the opportunity to understand and hear from management is valuable. Ben, we attended a very good conference held by Alex Waislitz of Thorney, a great Australian investor. Some people call him Australia's Buffett, not sure, but he's certainly a very canny investor. And we heard from a number of the investee companies. That was certainly a good day.
Amazing. An incredibly diverse group of stocks and a lot of companies we hadn't even heard of. So,
I think he bracketed them. There were, some listed here, some overseas, but there were some in the finance, microfinance area, resource companies, industrials, IT, healthcare. Of that one, I think we were both quite interested in a couple of those ones that were in that finance space, weren't we?
Definitely. Credible, I think, was one that we both thought was good, which is an Aussie business, which is really a US fintech that is helping American students to refinance their college debt and is now becoming a pretty major player over in America doing that. And I thought a very impressive CEO.
That was, very, and again, not profitable, not necessarily something that we'd invest in right away, but that was interesting. Another one was the LNG exchange, which is not yet listed on the Australian market, but plans to. That was very interesting, GXL.
Absolutely. So this is LNG is one of the largest traded products in the world, but it still isn't traded in an informed market. It's literally...
Contract only,
Contract only. A Woodside going to a purchaser and saying, what will you buy this for? And everyone tries to work out what the next one's worth off that one. And so these guys have started an exchange, like a stock exchange, I guess, for LNG. And put their first transaction through, which Petronas did out of Malaysia. It's got huge potential, risky at this stage. But I guess a good sort of case of what Alex likes to invest in.
It goes a bit of a theme there. Money 3 was another good one. I thought, largely in the lending against automotive particularly, which is a good segment and very profitable. And, there were some good companies presented there. We also went to the Livewire live presentation that was held yesterday. And again, you got some fantastic fund managers, companies, investors, credit and equities. And Ben, that was really eye-opening. There's quite a divergence of views about the market overall.
Absolutely. The credit guys are always bearish. I felt they're a little less bearish this time.
Maybe. Equities guys were bullish. We heard from Charlie Aiken, who these days is a fund manager. Everybody might remember him from his newsletter Ring the Bell, which was widely read. But he's certainly very upbeat. And the two themes that he came to the market with was addressable market size is important. So think global, and technology is so scalable. So think addressable markets, Asia in particularly, which are growing rapidly, and technology, which paves the way to further growth. And when you can find companies that have both of those things going for them, they're very good investment prospects.
Absolutely. And generally you do need to go offshore to find a lot of those businesses. But there's a small handful of them locally. The problem is they all look hideously expensive.
Well, this is right, one of the issues. Contractor space right now, but it's not necessarily an investment theme for just today only. It's one to play out over time.
Definitely.
Who impressed you in the Livewire presentation?
I thought Ben Griffiths from Eli Griffiths was good. I always find that fund managers, it's kind of in their interest to be a bit downbeat and bearish and to scare everyone a little bit.
Scare everybody, but give your money to me because I'll make it all right.
We'll look after it. So it's refreshing to see a fund manager who was upbeat, who felt like we have more to go. Ultimately, that'll be right. And some interesting calls on what parts of the market you want to be in. But look, there was some good stock ideas. At the moment, the areas of value in our market are generally in businesses which are facing issues. And you hope that the businesses' issues are not as bad as worst case scenario, and therefore you're buying cheap. Yeah. It is hard to find businesses with long runways of growth and those addressable markets you're talking about that are trading on reasonable PEs. But I thought, not wanting to get ahead of you, but we went and saw Challenger on Tuesday.
Yeah, Challenger. That was the investor day, which we thought we'd focus on a little bit because Challenger is a stock that we've liked for a while. It was interesting to get their update. One of the things when we go on the conference calls or meet with management is you often know who the CEO is. Generally speaking, knowing the divisional managers and people down the line a little bit is really quite helpful, and we certainly got that on Tuesday, Ben. Yeah. The very high quality of the divisional heads has impressed me for a number of years.
Yep, absolutely. And very stable. I mean, I think they've an average of 14 or 15 years they've been there. Yeah. Brian Benari, the CEO, was saying.
Yeah, it's a pretty impressive thing.
Yeah,
and to focus on the businesses within, Ben, I mean, obviously funds management, insurance, life, and we've got the annuities. And to me, the takeaway there was the annuities.
Absolutely.
And just how dominant they are in the space and how much growth there is. And there's good reasons why.
Yeah, look, I think we probably both underestimate, and I think the market has sort of missed that the government has brought in legislation in the most recent budget, which will kick in the 2020-21 financial year, which is now putting a legal obligation on trustees of super funds in retirement phase, so paying out income streams, that they have to start to look at investing in annuity or fixed income locked away style products. And they actually have to sign declarations saying that they've considered this. And, in Brian Benari's, the CEO's words, he said, this is a game changer for our business. So we put up we thought we'd speak to a couple of slides here that we're going to put up now. But the first one kind of addresses what the changes actually involve. And Jeremy, do you want to run through that? You're strong on this side of things.
Well, I mean, I think just showing how big that retirement phase will be through to the next 30-odd years, Ben. At this stage, I mean, the size of the industry is minuscule compared to the growth that's expected. We got a number that 15%, if that goes into annuities, over the next 35 years will be something like $200 billion, which is more than 200 times the size of the market in Australia at the moment.
Yeah. One statistic that is incredible is that between now and 2030, there'll be $1.3 trillion that is currently in accumulation phase in super will roll into retirement phase.
Yeah.
There's 700 Australians retiring every single day.
Yeah.
And when you look at the fact that in retirement phase, the trustees of these funds are now going to have to potentially put more in annuities, we are going to see a huge take-up of annuities.
And I think the point we're making here is a lot of our clients are obviously self-managed super funds. We're not giving advice regarding that just now to you. We will, but we're saying here is a massive investment theme which is going to affect the earnings very positively for people like Challenger.
Yep.
And the impressive feature here is Challenger is so dominant in this market.
Yep.
We're always going looking for players who dominate their market segment. Challenger is dominating annuities. But Ben, beyond annuities, there's a good story in funds management. They've probably after the investor day got some negative broker write-ups about the way they were reallocating their assets a little bit away from property into to lower yielding areas. But tell us, I mean, they're a substantial manager, Fidante.
Yeah, absolutely. I mean, I think they've got over $40 billion in funds under management now. And we'll put up another slide here that they spoke to. And I thought this was interesting because the press for the last year would lead you to believe that active funds management is a dead or decaying industry and that everyone is going into ETFs or passive management. And the slide that they put up indicated two things. They broke down the market into three parts here. We've got the passive guys, which are the ETS,
yes.
so BlackRock, Vanguard. That has seen 11% growth in FUM for the last 7 years. Mm-hmm. You've then got the active managers who aren't actually active. They charge as active managers, but they hug the index.
Yes.
And they're only seeing growth of about 6% per annum in FUM. But then you've got the active managers who truly are active, and of course they have to be successful as well.
Definitely.
But they're seeing flows of 20% per annum compound average growth rate for the last 7 years. So active is actually growing faster than passive.
Yes, and the one in between is really struggling.
Correct. And so I think there's a read-through into some other stocks from that.
So Finante, which is the challenger business, is well placed for that.
Yep.
People like Magellan, Platinum, etc.
Janice Henderson, BT, the Pendle Group now it's called.
Yeah, they're true to label and they're seeking out performance. So, but that's another side of the business. Obviously, the life business is a pretty constant business for Challenger. But talking about Challenger as a whole, it's trading probably on about 16 times earnings at the moment.
Yep.
Good earnings growth banked in, a nice yield,
yep.
a well-placed business with, very strong sort of opportunities in the Australian market and offshore, Japan particularly.
Yeah, definitely.
And some structural tailwinds as well.
Yep. Look, I think this is a stock that is going to fluctuate with the market over the next year to 18 months. It will still grow through that phase. The guidance I think is for sort of 8 to 10% earnings growth for the year. But I think from that 2020 to 2030 period, there is a wave of structural growth coming their way, which, you're going to see good numbers. And I think this could be one of the better financials on our market to own. When you look at a lot of the financials don't have a lot of growth, and the banks in particular at the moment, this is one where I think it's hard not to see pretty strong numbers coming through. So take a long-term view on it, as you should investing in any stock. But I think if you still own this in the late 2020s, you're going to be a pretty happy investor.
Excellent, Ben. Well, that's all we've got time for today. We'll speak to you again the next financial year.